Hello and thank you for joining us for this month's edition of AWM News Update. We have plenty to discuss this month.
Absolutely, Dariush. There has been a lot of buzz around the globe around the gender pay gap this month, and you looked at the UK market, especially with the uncertainty surrounding Brexit.
Exactly, and we have a report from Morgan Stanley, and this year seems to be the year of tech IPOs, which you will be covering in the alternative section.
There's a lot to get through, Dariush, so why don't you start us off and tell us how things are looking at in the markets?
Despite the Brexit buzz, the UK market has posted strong growth so far this year, growing from £1.29 trillion at year-end 2018 to £1.32 trillion at end of February 2019. While it hasn't recovered from the market's volatility seen in 2018, this echoes the overall industry. When we take a longer view looking at year-on-year, AUM has actually fallen by minus 2.8% from £1.36 trillion in February 2018 to £1.32 trillion in February 2019. Overall, the market split by type of assets remains very stable, with equity funds accounting for 52% of the overall assets, followed by fixed income at 19%, mixed assets at 16%, and money market at 2%. The fall we saw in overall assets is strongly reflected in net sales, with Q4 volatility quite noticeable. October saw sharp fall compared to previous months, and since then we have seen consistent outflows. Let's see what's been happening around the globe this month.
Well, Dariush, the gender pay gap is a hot topic this month. Fund firms failed to fully improve the gender pay gap, with the typical pay of a woman being around 31% less than a man's. Around half of the 39 fund firms that were surveyed by the Investment Association in the UK reported an increase in their pay gap figures.
US firms with a UK presence also had to provide their pay gap information. They showed better improvements as Wells Fargo experienced an hourly pay gap of 21% and a median bonus pay gap of 44%, down from 24% and 61% respectively from the previous year. These discrepancies are due to more men in senior, higher-paying roles. There is also a large pay gap in the fund space than in the broader financial services industry.
It's more than just about having workers of the same level in the same role or on the same pay, Dariush. It's also about bringing more women into an industry that has traditionally been male-dominated. This won't be an easy or quick fix, but at least asset managers in the UK have launched initiatives to help recruit and retain female staff, fostering a long-term foundation to diversify and bring more equality in the funds industry. We're joined now by Owen Alexander, PwC Global AWM leader, to discuss some of these initiatives. Owen, thank you for joining us. Could you tell us a bit more about the various initiatives being spearheaded by UK firms?
Sure, we're seeing a lot of innovation by UK asset management firms to address gender equality and diversity. So I guess one of the first things is raising awareness around the issue and then improving accountability. And certainly the Gender Pay Gap initiative in the UK has led to a lot of accountability. Year on year, we'll see reporting under the Gender Pay Gap regime, and hopefully over a number of years start to see some change. We're seeing a lot of innovation around how to recruit and retain female talent. And there is a recognition that this is really setting a foundation for longer term to diversify and bring more equality into the workforce. So some of the initiatives that we've seen some of our clients in the asset management industry bring in include special recruitment days, looking at very focused events around gender equality and hosting conferences. Also looking at the recruitment process and ensuring that there is no embedded bias there, improving unconscious bias training in their recruiters. We've seen one of our clients introduce a very innovative program around dedicated internships focused on women and minorities. We've also seen a number of firms bring in a lot of flexibility around working arrangements and working hours. And then another client has brought in parental leave for both partners in a relationship to make sure, again, that they're bringing equality to the equation. Another client has brought in an initiative to help with a program for returners to the workforce, so trying to attract finance professionals who may have left the working environment to come back to them, and making sure that that program makes that process as easy as possible. There's also a focus by many firms on female representation at senior levels and at management levels and in the C-suite, as well as focusing on narrowing that pay gap. So Hampton Alexander's goal of achieving female representation that equates to 1/3 of the boards by 2020, while ambitious, is achievable, and we are seeing asset managers really take that to heart in terms of board appointments that they've been making. There's a lot of networking going on and raising awareness around the issue, so I'm confident that the asset management industry is really serious about this issue.
Thanks, Owen. I think only time and concerted efforts from the industry will help improve over time, but still it's a long way to go.
Definitely agree here. However, it is good to see movements in this space. How are actives looking this month?
Active investment funds experienced more consistent performance in the first quarter of 2019. A survey from BMO GAM showed that the percentage of UK funds showing top quartile returns rose to 2.2%, up from 0.54% in the last quarter of 2018. After the volatility of the 2018 markets, this rise is hopefully positive for future active growth.
As one of the global leaders in active management sphere, Allianz JR are looking to diversify new strategies with the possible acquisition of DWS in the pipeline, further growing their AUM of 505 billion euros and forming a German fund powerhouse. Should this merger materialize, Dariush, the market players Allianz DWS, BlackRock, and Amundi would control 15.2% of the European market.
I think going forward, it will be interesting to see how asset managers will play this out, especially around JVs and organic growth as well as M&As. Now let's have a look at what is happening in passives this month.
The first quarter of 2019 saw strong net inflows for Vanguard. The company attracted more money this quarter than its top three rivals of BlackRock, American Funds, and Fidelity Investments combined. With a 25% commanding share of the total mutual fund and ETF market, they accounted for nearly half of the $136 billion in net inflows, with a total of $62 billion going into Vanguard funds this quarter.
Keeping with the strength of ETFs, BlackRock CEO Larry Fink believes that around 15% of ETFs are relevant, as they account for 95% of trading volumes globally. He also believes that ETF assets will continue to rise because of a better understanding from investors of these products. Regulators, on the other hand, are concerned about the potential dangers that ETF growth could have.
To shed some light on this, we have Beth Savino, PwC US's ETF leader, joining us. Beth, could you tell us a little bit more about behind the drivers of ETF growth in recent years?
Sure. Thanks, Oa. Happy to be with you guys today. So the recent growth in the past couple of years, it really stems, ETFs were started 20 or so years ago, but a lot of the recent growth has come since the global financial crisis. It's benefited a lot from a positive market. So since the market has been up over the last 5 to 10 years, passive investing in general has been able to show investors that they can trade along with the index. In the same period, active investing hasn't done as well as we'd had hoped. So when you have a fund that can follow the index for a cheaper price potentially, and with better liquidity, which is something that investors have looked for since the global financial crisis, it's made it a better vehicle for investors to invest into.
And what about some of the concerns that critics have about passives? Could you talk us through some of them?
Sure. So a couple of concerns. One is volatility. Critics have said that some of these inverse and leverage ETFs will lead to enhanced volatility in the market because you have to invest in an up market and sell in a down market, so it spikes the volatility in some of those leveraged and inverse ETFs. And then another thing that has been a concern has been index inclusion effects. For example, when a company is added to the S&P 500 index, let's say, the systemic risk or the beta of that company has tended to increase. Those are two of the concerns. But then on the flip side, there's also some benefits. So liquidity and redemption risk, because ETFs and at least most passive ETFs are in-kind trading vehicles. You don't have the same risk of a run on the fund or extreme redemptions on a fund that would create a problem in the market. So none of these things have been proven to be true yet. So we'll see where the market goes, and we're along for the ride.
Thanks, Beth, for that very helpful insight into the passive industry. Zoa, how about alternatives?
Well, 2019 seems to be the year many unicorns go public, much of which is being reaped by those PE and VC firms who got in on the ground floor. This is expected to have a huge impact on the PE and VC sphere in the coming months. Firstly, Uber rocked the market with its recent IPO. SoftBank Vision Fund has just under $8 billion invested in the company, while Morgan Stanley has also about $1.2 billion invested in Uber. It is expected that Uber's recent IPO will value the company at around $80 to $90 billion. This valuation is below its most recent private valuation of $120 billion. This could be a consequence of the poor performance of Lyft, another ride-sharing company down 15% since its IPO. Another hotly awaited listing is that of Airbnb. The company has been taking steps to go public, but they haven't explicitly stated that they will go public in 2019. With the expected IPOs of Airbnb, Pinterest, and the already listed Lyft, the rise of the tech IPO is generating a windfall of wealth. On the energy front, Saudi oil giant Aramco has reached a deal of $69.1 billion for a 70% stake in SABIC, a petrochemicals firm. The stake is held by Saudi Arabia's public investment firm in a share purchase agreement. This deal has delayed their expected IPO plans to around 2021. While many of the large private tech companies are looking to IPO, there's definitely still space in this market for VC and PE firms, especially as AI becomes increasingly more common and startups begin to expand in this area. Moving on from IPOs to this month's research report, let's see what it's about.
Morgan Stanley released a research report entitled Riding the Next Wave of Growth, Latest Trends and Opportunities, outlining that the perception of investors towards asset managers changed from 2017 to 2018. The report notes that they are no longer viewed as growth companies because asset management industry has gone ex-growth. In response to this, asset managers should set ambitious yet credible growth agendas through charting a course for emerging Asia and investing in alternatives and solutions.
The report goes on to outline that alternatives are set to surpass actives to become the largest revenue pool for the industry by 2023. The industry is also facing some challenges as asset managers have to restructure their business to promote future growth. From technological improvements to operational efficiencies and investment capabilities, asset managers really have a lot on their hands to keep themselves going.
Well, Zoa, I think also if we look at another point, asset managers are also servicing various generations, which have different investment priorities.
Right.
If we look at millennials, for example, they tend to focus also on sustainable investments, and they tend to have value for brands that have social and environmental values.
This is why a possible solution for asset managers is to redefine their value proposition with ESG products, increase stewardship, and improve governance that would also hopefully have a positive impact on the society. That's all for now, but don't forget to subscribe and click the bell to be notified about our next video.
Why not hit that like button or let us know what you think in the comments. Thanks for watching, and we will see you again soon.